The section talks about inventories as being assets. So inventories could be what are the items that are held for that particular organization in its usual or ordinary course of business. Okay, so things that they sell in their ordinary course of business. So this includes assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process in the in rendering the necessary services. So inventories are what we call those things. So now, what I want to highlight is this section C, in the form of material or supplies to be consumed in the production process or in rendering a service. So, for example, if I take my service to you, for example, this particular car. So one of the resources that I'm consuming is the internet connection, is the depreciation of the computers and so forth. So these are the consumables that I'm using, which are also considered as inventory. Okay. This section applies to inventories except work in progress arising under construction contracts, including directly related service contracts, etc. So construction contracts are not included in this particular section. Okay. Financial instruments obviously are not, which we discussed last time. Biological assets related to agriculture activities and so forth are also not included in this particular standard. This section does not apply to measurement of inventories held by producers of agriculture and forest products, agriculture produced after harvest, minerals and mineral products, because they can be very fluctuating in terms of how they are measured. And it's very difficult to measure or give a value to those things. Also, commodity brokers and dealers that measure their inventories at fair value, less cost of sales to process profit or loss. So these are the things that are that do not apply in terms of measurement requirements. Okay. So measurement of inventory, an entity shall measure inventories at the lower of the cost and estimated selling price, less cost of cost to complete the sale. So example, what we're saying is that inventory should be always conservatively measured. Okay. In other words, you're very careful about how much it is going to be measured, and you also have to keep in mind the reducing of the sales process. So the estimated cost of selling the goods. In other words, and the cost of displaying, the cost of actually making the transfers, any government charges, all those things have to be taken into consideration. Okay, so cost of inventory. An entity shall include in the cost of inventory all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. So that means if you're transferring it from one form to another, you need to include those costs in this in the cost of inventories. Okay, so I'll give an example. Does any one of you work part-time by any chance? Do you work for a family business or anything like that? Or does your parents own a family business, a small business that you know of? Anyone? Again, no answers. Yes or no? I would be delighted to get some feedback. No queries. Okay. Prof, you've requested some presentation files. This is the actual standard document. This is IFRS for SMEs. I think I sent it on the first. Do you want me to send it through again?
Prof?
Prof, do you need this particular document which I'm using as the presentation slide, or do you?
No. Actually, that has to be a little bit zoomed, Professor. It's very small.
Oh, sorry. Got it. Okay. Is that better?
Yeah. Yes.
All right. That's better. Thanks. I'm wearing my glasses, so probably for me it's a bit more larger. Sorry for that. Right. Okay, so we were looking at an example. Does any one of you or your parents own a company that sells something? Anyone?
I think they answered no, Prof.
Okay, no one. Okay, that's all right. So let's look at a more simplistic example. Okay, how many of you cook at home? Chaubati, you've made some excellent dishes in the past. So can somebody tell me what is the cost of inventory of transforming vegetables that you have purchased into a dish? A simple question and something that you do every day.
Nil.
Sorry?
Nil, sir. Nil.
There's
There will
no
be no
cost.
cost.
How is
There will
that?
be no cost.
Why not?
Because I want to eat it at the end of the day. So only.
So what is the cost of producing it?
Cost
So
of producing.
what about the payments you made for the vegetables to the person who sells it? That's the first cost, right?
Yes.
The price of the vegetables, sir.
The price of the vegetables is one. Then what about the cost of you paying the bus fare, the petrol
Transport
going to the shop? Transport cost. Correct.
It
What
will be
about the cost
negligible,
of,
I think so.
you can't consider it as negligible if you're looking at it from a monthly basis or a yearly basis. Yes, from a daily perspective, it might be negligible, but let's say if you're doing it every day for 365 days, do you think it will be negligible?
Actually, we will not consider 365 days. We will not purchase, sir. For monthly.
So this is where you need to change your thinking that every little cost adds up. Okay. So let's take an example on that point, because if you think that the cost is negligible, let's say if I spend $1 for a cup of coffee every day in Melbourne, $1, which is like I'm not sure how many rupees that would be, but if I spend $1 a day, yeah, in the grand scheme of things, $1 a day is nothing. But if I look at it from a monthly perspective, $30, give or take, if it's 31 days or 28 days or whatever, but let's say $30 on average, it's a little bit more. But if I look at it from a yearly perspective, you're talking about $365, which is then becomes a big amount. So you cannot say that it is negligible, because from a company's perspective, every little cost needs to be considered, and if you don't, you will make bad business decisions. Okay? So this is a good discussion. So I'm giving you some practical advice. I have been a CFO of a company, a SME, and I'm telling you that if you do not consider these little costs, they add up to be large costs. Okay, right. So let me give an example. Okay, just to continue with that particular example we're talking about. If we were talking about the cost of vegetables we paid to the supplier, the transport cost to and from your location, the cost of gas or firewood or whatever that you use to cook, okay, the cost of water for washing the utensils, the plates, the pots that you cook in, yes. So all these things are added to the cost of production. So in other words, next time you eat a dish, think about everything that you have put in there and your time. Don't forget that, your expertise. How much is your time worth? So all of that has to be taken into account, the labor cost of production. So your time, let's say if you spend 1 hour in cooking or 2 hours in cooking, how do you charge that amount? So if you consider all these things, a dish that you make, then you have to look at the cost of goods sold. So in that context, do you still agree that the cost is negligible?
Actually, I read the article about it, sir. One Emirates flight about it. They decrease the weight of every magazine for 1 ounce, and it gave them the profit of $250,000 like that.
Exactly my point. So never ever say small, if any cost is negligible. From a business perspective, every cost is relevant. Okay, so keep that in perspective, and that's why pricing of a particular inventory is very important, because when you price inventory properly, your profits would increase or decrease. Just imagine. Now, I'll give you another example which I was involved with. So when I took over as CFO of this manufacturing company I used to work for in Melbourne, they were pricing products at a flat rate. Okay, so what they did was they calculated the total cost of goods sold, total cost of production, and then divided it by the number of units produced, and they sold it like that. The problem was each of the products were different. They had 30, 40 different product lines, and they were not properly costing individual production costs for each of the product lines very correctly. They were taking holistic approach. Okay, so how they consider profit margin is whatever, just double the cost. It doesn't work that way. You need to look at things that are not considered as if you're a good manager, you will be really good in calculating the entire cost of goods sold. Okay, so coming back to our very simple example, Professor Charumati, if I ask you, if I'm from an Australian context, if I go to the shop, if I buy vegetables, if I come home and if I cook, and if I spend 1 hour, my time, including and everything else, I would, let's say I'm going to cook a kilo of 1 kilo of beans, for example. Okay, beans would be about $5 here a kilo. So is it worth for me to just buy the product ready-made, or is it worth for me to cook the product? So these are the questions that you have to look at it from a corporate perspective as well. For example, as a manufacturing company, should I manufacture the product or should I be a reseller of a product? Do you understand? So these are the dynamics that you need to look at. So in some situations, I'll give another example. With my previous company, some of the product lines I actually stopped producing because the cost of production was higher than the cost of purchasing the ready-made product from another country. So what I did was I cancelled or closed down the manufacturing operations in Melbourne and started buying the product from 3 countries, or manufacturing the product at another country and bringing them over here. So I outsourced some of the production to China, India, and Sri Lanka. So I had 3 foreign organizations, or 3 countries, 3 organizations in 3 countries supplying me with that particular product at a lower cost what it would have cost me to produce it in Melbourne. So that is why the calculation, the proper calculation and costing of a product or inventory is absolutely crucial to any organization. Is it clear so far? Have you learned something that you were not too familiar with? What do you think? Kids? Yes or no? Yes? Kavya, have you thought about this before? Anyone else? Any comment?
Yes, Professor, I can understand it. Like, we have to make decision based upon the cost what we incur.
The overall cost, not just the single cost of a product, but the overall, the cost of the value chain of producing that particular product. So for example, that will determine whether you buy food from a shop or cook food at home, wouldn't it? And that is why sometimes it's cheaper to buy from a mass producer of product than making it at home.
Just in time.
Do you understand? Sorry?
just-in-time inventory process like that, sir.
Just-in-time inventory is exactly what I introduced when I was for my previous company. So yes. Okay, I'll explain a little bit more of that discussion later on. Okay, now let's move on. An entity may purchase inventories or deferred settlement terms. So what they're saying is that there's usually what we call a payment period for suppliers. So for example, there is what we call a 30-day net, 45-day net, 60-day net, 90-day net. What does that mean? What does 45-day net mean? Anyone? I'm sure you know what it is.
If they get the raw materials, they can pay for it within 30 days or 60 days gap.
Correct. So what you do is you're actually deferring the payment, so that gives you time to produce the good, sell it, keep the profit, and then return the cost to the supplier. So that is why we have what we call payment terms. In some cases, the arrangement effectively contains an unstated financing element. For example, the difference between the purchase price and the normal credit terms and deferred settlement amount. In these cases, the difference is recognized as interest expense over the period of financing and is not added to the cost of inventory. So this is a unique case where in some cases arrangements effectively contain an unstated financial element. For example, the difference between the price of for normal credit terms and the deferred settlement amount. So what we're saying here is that if there is an interest component, for example, if you buy the product from the supplier at 100 rupees and you have to pay in 45 days, if you have to pay 105 rupees, you are actually paying an interest on that credit. In most cases, companies don't do that, but there are instances where that happens. In that case, that 5% is not considered as cost of goods sold. That is a cost of financing. It's a finance cost. Okay? Do you understand the difference? Yes? All good? Okay. Cost of conversion. The cost of conversions of inventory includes costs directly related to units of production, such as direct labor. They all include systematic allocation of fixed and variable costs. For example, now this is important. Let's say another thing to consider is let's go back to a very simple example of cooking. Okay, Professor Charumati. So, for example, when you cook for an hour, I'm sure you don't look at all these different costs, but for example purposes, in your case, would you consider, if you're paying a mortgage, would you consider adding a percentage of or a small percentage of that cost to your time, for example, if it's a 30-year mortgage and it's 1 hour, have you considered that or have you thought of that? What do you think?
To be honest, whenever I'm cooking, I have this thought. Actually, by the time I spend for 1 hour, I could have done some reading. So I always
that's the
have
alternate cost, the opportunity cost.
Yeah. So,
yes.
But for the health of the family, we are doing it. But I always feel that this 1 hour could have been used for reviewing an article or doing something.
Yeah. So that is what you call the opportunity cost. So that's fine. So you can see that there is what you call direct and indirect cost. There are fixed costs and variable costs. So fixed cost is, for example, the rent paid for the office, or in this case, in my example, the mortgage cost. If you're paying a mortgage or rent in your home, that is a fixed cost. So whether you cook or not, you will still incur that cost. What is the variable cost? In this situation, what is the variable cost?
The fire.
The fire, the gas.
Electricity we use for the cooking.
The electricity, you have the light on, the fan on, yes. What else? What about the condiment?
Water.
Water. What else? What are the condiments that you use? Masala powder, curry powder.
And the vegetables we use for cooking.
The amount of vegetables is a variable cost, yes. but then that's the amount of vegetables is actually the product cost. I wouldn't consider that as a variable cost per se, because it's a direct cost. So variable costs are the additionals to the product. So I wouldn't add that as a product cost. Okay. What do you think? And then also we have these other things like your time. Okay. Now, also there's another aspect to consider with cost. Have you ever thought of depreciation cost? Meaning every time you use your stove, it's depreciated, because let's say how long can you use a stove? 10 years? 5 years? How many years would you use a stove? How big do you cook at home, or do you eat out? You rarely cook. Why? Why is it that you rarely cook? I'm interested to hear. What is the reason? Why do you buy from out as opposed to cook at home?
So,
Time factor. In other words, what you're saying is the cost of you cooking at home outweighs the benefit. Yes. So it's cheaper for you to buy and eat from outside than cooking yourself in terms of time. So that's exactly my point here. Now, but depreciation, so that means your stove is not depreciating because you're not using it.
Not only environmental concerns such as soil erosion and coal consumption is involved, but also it houses the abysmal working condition of more than 10 million workers in India.
So in this case, the benefits are significant and they are significantly different. Okay, so there is more than one byproduct in this situation. Okay, what are your thoughts on this particular situation? So what are the byproducts? So if it's a bottling company, you have the plastic resources that are coming as a byproduct. And also on top of that, they're talking about the social benefit of product, the social benefit of what's happening. So that's also very important thing to consider overall. Okay. So any questions up to this point in time? Okay. Other costs included in inventory. So an entity shall include other costs of inventory only to the extent that they incur in bringing the inventories to their present location and condition. So transport cost is obviously one of them. Okay. Paragraph 12.19b provides that some instances the change in the fair value of a hedging instrument in the hedge of fixed interest rate risk or commodity price risk of a commodity held adjusts the carrying amount of the commodity. In such situations, what we are saying is that certain hedging instrument cost, if it goes up or down, can be included in the cost of goods or the calculation of the cost of goods. Okay. Costs excluded from inventories are examples of costs excluded from cost inventories and recognized as expenses in the period in which they are incurred are the abnormal amount of wasted material. The abnormal amount. Okay. Labor or the production costs which are above and beyond the normal process. Let's say, for example, if there was a error or a fault in a particular product and then you spend abnormal amount of waste and abnormal amount of time, that is an expense and that should not be included in the cost of goods. Okay. Storage costs, unless those costs are necessary during the production process before a further production stage. Only if it's in between, not the storing of the finished goods. We cannot include the storage of finished goods in the cost of goods sold. Okay. However, in saying that there is that overarching cost, fixed cost, which needs to be calculated in the pricing strategy, not necessarily in the cost of goods sold. Okay. Administrative overheads that do not contribute to bringing inventories to their present location and condition. So any indirect costs we're talking about here are not part of this process. And also cost of selling. But in saying that there are certain costs, if for selling cost is what we're talking about, advertising costs, commission, those are not directly related to the product cost. But if there are anything that is directly related to the product, for example, the requirement to package a particular product in a particular way, that is a part of the cost of goods. Okay, is that clear? Okay. In terms of cost of inventories for service providers, to the extent that service providers have inventory, they measure them at the cost of their production. These costs consist primarily of labor and other costs of personnel directly engaged in providing the service. Okay, including supervisory personnel and attributable overhead. So for example, in situations, we look at call centers, or if you look at the programming or legal costs, they look at all the cost of time or labor, how many dollars or how many rupees per hour are you going to charge a particular person? So that's what we are looking at in that case. Okay. Cost of agriculture. Products harvested from biological assets. So section 34 requires the inventories comprising agricultural produce that an inventory is harvested from biological assets shall be measured on initial recognition at the fair value less estimated cost to sell at the point of harvest. This becomes the cost of inventory at the date of application of the application. So let me just find, I was going to share with you one other thing. Let me see if I can find it. Bear with me.
All right, guys, what is cost of goods sold?
All right, can't seem to find it, but I'll try to get it some other time before we finish. All right, that's okay. All right, now techniques for measuring costs, such as standard costing, retail method, and most recent purchase price. All these things can be used for measuring the cost of goods sold. Anything can use any technique that is acceptable in measuring the cost of goods. Standard cost method, the retail method, the most recent purchase price of measuring the cost of inventories, and all these things. Okay, so there are different costing formulas that you can use for this. An entity shall measure the cost of inventory of items that are not ordinarily interchangeable and goods or services produced that segregate for specific projects by using specific identification of the individual cost. So depending on the type of the product, you need to rethink how you measure it. Okay, so there are a number of ways in that you need to do it. For example, the other thing that I want to talk about is the impairment of inventory. Impairment means depreciation or things like that of particular products. So for example, milk can only be stored for a very limited period of time. So they have a high impairment cost. Okay, so all these things have to be taken into account as well. So paragraph 27.2 and 27.4 requires an entity to assess at the end of each reporting period where any inventories are impaired, i.e. the carrying amount is not recoverable. For example, damage or obsolescence or declining selling prices and so forth. All these things are an issue. For example, when it's summer, when it's very warm during your non-monsoon season or non-rainy season, do you think there will be a significant demand for umbrella as opposed to a situation where it is monsoon season and then everybody wants an umbrella? What do you think? Can you tell me an example in your experience, in your day-to-day stuff in Pondicherry, where at certain times the cost is higher and other times the cost is lower? Can you give me an example of a product?
Seasonal products like fruits.
Yes, that's a good example. Yeah. So can a student give me an example, please? Another one, something different to what Professor Charumati gave?
Seasonal products like fruits.
Yes, that's a good example. Yeah. So can a student give me an example, please? Another one, something different to what Professor Charumati gave? Anyone?
I think electronic items.
Electronic
Then
items. Give me an example.
and then the alcohol like that thing.
Give me an example of an electronic item that during some time it's more expensive and other times it's not.
In Pondicherry, the tax rate is very low. So most of the
Yes.
electronic items price also so low, I think so.
So what I'm asking is not the price of electronics. What I'm asking is the seasonal nature of it. Of cost. So give me an example that
air
you think
conditioner
is
during the summer season.
exactly. So that is a good example. So in summer, air conditioners are more expensive than in the cooler period. Exactly a good example. So all these things have to be taken into account. Okay, when that's what we call impairment of inventory. Okay, so recognition of expense. When inventories are sold, the entity shall recognize the carrying amount of those inventories as an expense in the period in which they relate to revenue. Is also recognized on the other side of the equation. So there is a cost and there is an income. So it's always a revenue. Okay? There's always that balance we talked about. Okay? And also the entity must also disclose the accounting policies and all these other things. I'm not going to go through it in detail. Okay. Now, I think we will have just enough time to finish investments in associates, and I'll probably stop after that. Okay. So the scope of this particular section, or section 14, deals with the section applies to accounting associates in consolidated financial statements and in the financial statement of an investor that is not a parent but that has investments in one or more associates. Okay. So in this case, paragraph 9.26 establishes the requirement for accounting for associates in separate financial statements. Okay. So again, it's very rare that you will have to go through things like this in an SME environment. Now, Professor Charamati, I'm very critical about the release of the document IFRS for SMEs, because majority of these things does not apply to SMEs in most cases, but the standards are all there, which is pretty much very close to the IFRS for SMEs is very close to IFRS as well. So there is that reduction in gaps. So this is a critique that I need to make here. Again, very rarely will you be seeing SMEs that deal with situations like this, but as a need for completeness, we'll definitely go through this anyway. Okay. Now, before I go into this next section, do you have any questions in relation to inventory? Anything that is unclear? Anyone? Last chance to ask any questions.
Just in time like that.
Sorry?
Just in time. Okay.
Okay. Yes. I promise to give that example. Good. Okay. So just-in-time inventory is a situation where you only buy in the inventory as and when you need to sell it. So in other words, I'll give you a good example of what I did in my previous company where I worked. Okay? So what happened was we bought this massive warehouse. Okay, I'll just give you a bit of a background story. We were paying a lot of money in the city for a warehouse at rent. So we were paying something like $7,000 a month on rent for a warehouse in the city. At the time I took over as CFO. What I did was I looked at this and I said, this is too much. So I actually purchased our own house or our own warehouse, okay, just outside of the city, which is about 20 minutes drive from the city, which is not very far, okay, of Melbourne City, in the northern suburbs of Melbourne. And the pricing is irrelevant. What matters is our mortgage per month was $5,000 or 4,900 and something like that, or close to 5,000, let's say 5,000. So here immediately there is a saving of $2,000 to the company. Yes? Yes or no? On top of that, okay, on top of that, we are actually paying towards our own premises. In other words, out of that $5,000, probably about $3,500 goes as interest, and $1,500 goes towards the capital. Okay. So then what I did was, we had this massive warehouse storing stocks, which I thought was very time consuming. What I did was I divided or partitioned the warehouse into two sections. So 3/4 of the warehouse with its own office space, and then another quarter of the warehouse with an office space to a smaller one. So what happened here is that I cut down the inventory significantly. So then what happened was, instead of retaining inventory, I got the supplier. I agreed, we had a negotiation and we came into an agreement with the supplier, asking the supplier to directly ship to the customer with our badge on it. So what they did was, from the supplier, they would put one of, I provide stickers, our company logo stickers to the supplier. So what the supplier did was, whenever they got an order from us, they put our sticker on top of onto the product, and they delivered it directly to the customer. Does that make sense? So that is an advanced form of what we call just-in-time inventory system. In that case, I'm cutting down a lot of costs. Transport costs from the supplier to us and us to the client. So that's the immediate saving. What else? Storage costs. For us to bring it there, store it, reprocess it, and then send it again. Time cost of labor. So all these things, so what we did was, because of this just-in-time or direct shipping method, we were able to give that savings to our customers. So in other words, they saved a lot of money in terms of the product. Now, the suppliers are wholesalers. They do not directly sell to the customer. So in that sense, we were not worried about them undercutting and then cutting us off the market and then directly going to the client. So that was not happening, because the databases, the contacts were with us. And that is why in my first lecture, when I talked to you about integrated reporting and integrated thinking, we talked about the social and relationships capital. Okay. So for example, I wouldn't be coming and teaching you now if I did not have this association or the social and relationship capital with Professor Charma. Because we have this social and relationships capital, I am here and doing this presentation. Similarly, it is that social and relationships capital which is equally important in terms of cost of goods. When considering the cost of products or services, that you need to not look at it in that pure limited vision of just looking at it from one narrow perspective, but you have to look at the broader context of it as well. Does that make sense? Any questions?
Nothing.
Okay, good. So let me see if I can go to the next one. Right. We've got another 12 minutes. Don't be able to do everything here, but let's see how much of it we can cover. Okay. So investments in associates. Again, I talked about the need for a. Yes, Prof?
A little bit zoom.
Oh, sorry. Yes, sure. One moment. Is that all right? Okay. Right. What is an associate? So this is, I wouldn't mind spending some time here, which is very important. Okay. An associate in an entity includes an unincorporated entity such as a partnership over which the investor has significant influence, and that is neither a subsidiary nor an interest in a joint venture. Okay. So here is a situation where an investor has significant influence that is neither a subsidiary nor an investor in joint venture. Significant influence is the power to participate in financial and operating policy decisions of the associate, but is not control or joint control over those policies. In situations, shareholders or institutional shareholders is a good example of such an example. Okay, if an inventory hold, if an investor holds directly or indirectly, for example, through subsidiaries, 20% or more of the voting power of the associate, it is presumed to be an investor has significant influence unless it can be clearly demonstrated that it is not the case. So anything over 20% of investment is considered as being a significant influencing investor. Okay. Conversely, if the investor holds directly or indirectly, for example, through subsidiaries, less than 20% of voting power, it's presumed that the investor does not have significant influence unless such influence can be clearly demonstrated. So I'll give you another example. In my previous company where I worked in, which is, I think it's got a lot of good examples there, Prof. That's why I'm bringing that over and over. So what happened was, there was this, it had a couple of investors, obviously, particularly two investors who was the two managing directors, okay, the two CEOs of the company, or who we call managing directors. They had a significant amount of money into it, a couple of $1 million, okay, and this couple of $1 million included about close to 75% of the shares, okay. Now the rest of the 5% was actually funded through loans, but I think close to 20% of the investment came from the wife of or wife family of one of the two main investors. Okay, so in other words, it came from the wife's father. So in that situation, though it's a family business, an SME, even though the managing directors were these two people, what do you think the role of the father-in-law of the managing director is in this context? What do you think? Is he a controlling investor or is he not a controlling investor? Does he have significant influence or not? What do you think? Does he control the operations? Does he control the operations of the organization? No, he doesn't. He doesn't control, but does he have significant influence? What do you think?
Significant influence, I think.
You would have significant influence, correct. So in that situation, he was somebody that we needed to keep happy, even though he was not directly involved with running of the company. Okay. Measurement or accounting policies election. An investor shall account for all of its investments in association or in associates using one of the following methods: the cost model, which we'll cover in paragraph 14.5, the equity method, or the fair value model. Okay, so let's quickly look at these three models. The cost model. An investor shall measure its investments in associates other than those for which there is published price quotation at the cost less any accumulated impairment losses recognized in accordance with section 27, which is the impairment of assets. Okay. I'm always of the viewpoint that you need to look at it from a very conservative perspective all the time. Okay. Right. Do you have any other questions up to this point? Any other questions up to this point?
Is this all come under supply chain management?
Sorry?
Is this like more like supply chain management?
Supply chain management?
Yeah.
Not necessarily, no, it is not. So that's a different thing altogether. Okay, this is supply chain management is a completely different aspect. We are looking at the cost model. We're looking at it from investment point of view, how we measure our investments or the value of our investments in a particular situation. Okay, so that's significantly different. So give me 2 seconds, bear with me. I think I just need to check. Right, sorry about that. Right, so we were talking about the cost model. I might just, because of time, I don't want to kind of go forward in this because it's going to get me to rush through. What I'm going to do is the cost model. Let's leave it at, let me just finish these last 2 points and then we'll stop it at the cost model method. Okay. The investors, as I said, shall recognize dividends and other distributions received from the investment as income, without regard to whether the distributions are from accumulated profit or whatever. So if I'm getting some income from this particular investment from this company, I consider it as income. An investor shall measure its investment in associates, for which there is a published price quotation using the fair value model and so forth. Okay. So again, always remember, the key takeaway from this is always measure things at a very conservative way. That is the takeaway from this. Okay, Prof, without further ado, I will then stop it from there because we have your next class to go to.
Yes, sir.
I've stopped recording now. So I have time for one quick question before you go away. Is everything clear up to this point in time? Have you gained some interesting knowledge from this particular class before we move on?
Sure, yes, Prof. Students.
Thank you. What about the other students? Have you gained anything from this?
We gained about how negligible costs will impact the whole process like that.
So you have learned something?
Yeah.
Okay, good. All right, then thank you, Prof. Then I'll leave it at that and I'll see you next week on Wednesday.